Welcome to this edition. My name's Andrew Wilkinson with Interactive Brokers. Now, President Trump is putting America first in terms of economic and foreign policy. Here to discuss the first several weeks of a second term in office and its impact on China is Xiaolin Chen, Head of International at Crane Shares in London. Welcome, Xiaolin. How are you?
Thank you, Andrew, for having me on your program.
You're very welcome. It's great to have you back. Now, Xiaolin, Trump has so far pulled no punches when it comes to addressing global conflict and his ambitions for China.
Mm.
Recently, the U.S. Committee on Foreign Investment in the U.S. restricted Chinese investment in strategic U.S. sectors. Tell us how you view the first several weeks of the Trump administration with respect to his dealing with China.
I probably will be on the other side of the scale when I view this U.S. and China relationship. I remember when he first get really elected, confirms he's get reelected, market expectations straight away pressing in massive tariff, massive tough talk, so on and so forth. I remember reading some very top rated, I shall not name them, but very top rated research house saying 95% of the chance the U.S. will put 60% tariff on China. Okay. And then a week later, when he got into office, he introduced 10% tariff on U.S. China exports imports. But put that aside, and then straight away, that research house downgraded the probability from 90 to probably about 60%. But then the rates become 60% risk tariff down to probably about 30-40%. I mean, Andrew, if you do annualized rates, that's going to be zero soon. My best reaction to that is no one really knows exactly the outcome, but there are certain things investors should differentiate. One is what is President Trump has been saying during his election campaign process. He claims certain things. He has to deliver certain message to the actual implementation. It's a journey that could full of uncertainties, full of things we don't know. If you ask me the first few weeks, I see it as positive. Why? First, they are talking. They are talking. All we need to do is number one, world's largest economy, and second largest, they talk. They talk constructively. They look for a way to work together. I have to say, this time around, versus the first round, that China really caught off guard. Like they didn't know, wow, this can happen. They are very well prepared of Trump 2.0 in terms of tariffs. So when they react, they also react. We don't want that. We want them to talk, which they are talking. They invited senior officials to Washington. They were talking. They were apparently Xi Jinping and President Trump are exchanging letters to exchange opinions. There are people who are very familiar with the matter that this is Terry Branstad is American's U.S. ambassador to China during Trump's first administration. Apparently, he's also talking to China's officials on how we can do a deal. If you ask me, music to President Trump's year this round are more constructive. Are young entrepreneurs. They want to do things, want to see actions. They want to see actual things happening. I say this time around, they can be very constructive. The shock, the surprise caught the market off guard will be less in this term and more of a constructive find a path to work together.
Now, given that Chinese corporate investment into the United States has all but dried up,
Mm.
how do you estimate the impact on China's economy?
This is two ways. Is inflow and outflows. Chinese outflows to outside of the world in a big way in investments has completely, like you said, also quite dried up. What happened was really pandemic, and then they have to deal with themselves in domestic issues for nearly 3 years. So a lot of investments saying, you know what, I need to look after my home territory, which is naturally understandable, before I can run to internationalize my business. I might as well focus on my domestic economy, which that's why international investments from Chinese corporates to go outside of China also slowed down massively over the last few years. I only see that would be a result if US and China talk more constructively. There's more created room for them to work together. They will come back. The Chinese investors always look up to US market as a benchmark, as where they would like to look up to. I'll give you an example, Andrew. When Alibaba listed in New York Stock Exchange, it's dream come true. Any entrepreneurs in the unicorn size wants to go public. They look up for United States. We need
Mhm.
to reinstall that confidence back for all these companies to say, you know what, we want to go to US, which they do. It's just how we're going to create the environment to welcome the investments come to United States. The other way around also. I give more credit for the other way around, which is the inflow to onshore China. Since Q1 2023, the Chinese policymaker has been doing nothing but stimulus after stimulus, easing policy after easing policy. And very recent, they have President Xi Jinping just met huge crowds of the private entrepreneurs. They call them private, but they're public company, just not owned by state. Private CEOs come to my office. I'm going to see you. Andrew, this is very rare. He doesn't do this. This is the first time you see all these CEOs. He said, listen, we're going to remove the hurdles, remove the access, and give you a level playground leveling. Okay, everyone have the same access. All you need to do is stay focused, grow your business, grow your income. Andrew, to me, that is begging the consumption to come back. Private entrepreneurs, enterprise, they hire 80% of Chinese employment. Okay, so I say now is very much a very accommodating macro environment. Foreign money has started to go back to China. We have witnessed in February nothing but outstanding flows into China's capital market as our fund benefits from it. And I think it's just a matter of time for these corporates to feel more confidence, getting more partnership onshore. I see domestically more constructive steps being taken towards that goal than externally.
Xiaolin, last time we spoke, I think in September, there were massive Chinese government and central bank moves to launch significant stimulus programs, and you were very optimistic about it. And you weren't alone in that sense, by the way. Does the optimism surrounding those initiatives still hold today?
Absolutely, Andrew. I would say if not more. The reason I say that, obviously, the performance has to show the results. If you started to allocate from September till now, you probably returned over 50%. And also outperform all the benchmark, anything you can benchmark and think of. US or Europe, any benchmark wouldn't return 50% during that period of time. The reason I say they still hold and true, valid, and from now and continuously is monetary policy we discussed, very accommodative. Interest rates, they cut multiple rounds. They still have room to cut. That's one. Second, physical. Are they spending? They issued for a very long period of time, probably over a decade. They haven't issued ultra long dated bond fund, which they issued to create liquidity, to ease pressures of local government. And then they start to remove all these hurdles, regulations, so on and so forth for corporates. They did that. All they have done from October meetings and November, they had ad hoc meetings as well, is to announce more and more accommodative policies around it. What impressed me for this round of policy bazooka is implementation. Say one thing, do one thing is totally different story. From them announcing the policy to actual implementation, Andrew, it's a matter of a week. That's gave me the confidence to say, you know what, you really sincerely meaning you want to stimulate this economy. You have the cash, and don't forget, Andrew, now they have the national team. The national team, which means pensions, all this government money, start to buy A shares, buy their stock. When I say A shares, Chinese equity. They start to buy the equity. Just like a few years ago, remember, Andrew, Japan, they started to say pensions all got to buy Japanese ETF. And this is exactly what happened to China. They say, big insurance company, from now on, you need to have at least 10% in your allocation is A shares. It's a must buy. And then all the rest of national team to say, here you go, 2 trillion. You can start buying. They would announce every time they buy. Every time the market see they sell off, they say, we come in. At the moment, announced quota used around 20 to 30%. So you give or take about 400 billion to 600, less than 600 of the 2 trillion. And they say, if it's not enough, we are prepared for the next round and next round. This is the Fed. We say don't Fed with the Fed. And now Europe says, you know what, we do whatever it takes for it works. Top down, you have a confirmation for sure.
Xiaolin, give us a weather check on the status of Chinese stocks. The market has outperformed recently, as you say. What's done well? Give us a sense of that outperformance in particular sectors that's benefiting from the market rally.
Great question, Andrew. September, when you and I last check in, was beta. Beta means broader market. Anything you buy, man, is so depressed for 2 years, everything goes up. But now we say you got to differentiate what you own and which part of the curve of the rally you got to own. If you ask me, you got to look at, because China is a developing country, policy matters the most. And all the policy today announced are centered around consumption. They want the consumer to come back. The private corporate hire people, expand your business. Why? You got job employment going and I have a better pay. Only that the Chinese household will start to feel more comfortable to spend. By the way, Andrew, China's issue is not a liquidity issue. Chinese household is damn rich in cash. So this is actually not a liquidity issue. It's a confidence and sentiment issue. So this time around, I say, you know what? You got to have the confidence to allow the corporates to play on these cards. And then all these macro policy states continue to be positive. You will see eventually the key indicator is credit. Everyone started to take credit, corporate, household, both included. And we have started to see the sign of a strong recovery of credit in China. In January and February, obviously, it's a still short period of time. But at this moment, the consumer-led stocks, but they call them internet technology. That's a dated name, but they are, like I give you an example. Some of the e-commerce names in our fund is like Alibaba, Tencent. They are not just e-commerce company. They own clouds, they own entertainment, they own AI, they own autonomous driving. All of them in China is one business for all. You got to own the entire ecosystems of China's consumer consumption system. So if you ask me, I say, centered around the policy, centered around the stock, those stocks are still depressed in valuation. And the other last space, and I'll pause, is these companies saying, you know what, our earnings has started to show sign, our profits also catching back to pre-pandemic level. If you don't believe in our stocks hugely undervalued, we'll buy our own stock, which all of them has announced share repurchasing program. That's why we see they say we're going to buy our own stock back. And use Ali as an example, they're going to shrink their outstanding shares by 14% by end of the share repurchasing program.
I was just going to ask you about Alibaba. That's been an exceptional performer, particularly on the hopes of massive investment in AI.
Yeah.
Is this a trend that's likely to stay with us even as global stocks look a little bit nervous?
I think obviously Alibaba is very strong in terms of developing and continue to develop their AI capabilities. Okay. These companies are slightly different. DeepSeek is a huge boom to the AI market. And obviously, Ali's focus was always, I may not have the best advanced chip like NVIDIA, like in US, but all these Japanese companies now shifted the gear of AI to say, you know what, the hardware is important, but the software, the actual application, actually usage is even more important. With Alibaba, remember, they developed their own chips that is inference that try to work out the logic to use in the robots and so on and so forth. They have improved to be huge successful. And today they just made another announcement to produce an AI development. I just say, stopping or restricting the Chinese companies from accessing to chip doesn't actually help. So working together, the benefit is you and I as a user. And I give you an example. Alibaba's rally is obviously three reasons. One, long-term depression of the market. Investors discounting, regardless of your fundamentals, we're going to sell your stock if there's headline news. Many times, Andrew, I have a free voice here at your program. But when I go interview elsewhere, they say, oh, they sell stock down 10%. Just explain that down 10%, right? So what? And so fundamentally, they have a lot of good story happening in the company. It's not pressing by the market. And also, this quietly silent side of developing the AI software development side that the Chinese company has proved to say, we don't really care DeepSeek use 5 million or 15 million. The point being made is they use a very friction of the cost and develop a very usable software development, a breakthrough of that. I see Alibaba has a long way to run. They have a video game they can play. They have AI they can play. And remember, they announced this 1+N of all their subsidiaries to go IPOs, one Alibaba, their logistic, their cloud, so on and so on. That was still a discussion. I remember last year when I go to Vietnam to visit their headquarters of logistic company, they told me, they said, listen, we're ready to go IPO. It's just waiting for the right moment. Market has not even pressed in that Alibaba potentially can become a parent company of multiple unicorn IPOs company.
Very interesting. Xiaolin Chen, Head of International at CraneShares over in London. Thank you so much for joining me again. It's always a pleasure.
Thank you, Andrew.
Thanks. And to the audience, thanks for sticking with us today. And don't forget to subscribe to this channel wherever you download your podcasts from. Bye, everybody.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. Any discussion or mention of an ETF is not to be construed as recommendation, promotion, or solicitation. All investors should review and consider associated investment risks, charges, and expenses of the investment company or fund prior to investing. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice.